Okay, well, good morning, everyone. Luke Mandekic from Channel Capital here. Welcome to our first market update for the year with our specialist emerging and frontier markets manager, Redwheel, better known to a lot of you as RWC partners. So today's session has been quite keenly anticipated by a lot of our clients, given the sort of state of play in the emerging world and markets more broadly. Clearly the devastating situation in the Ukraine is really capturing a lot of the attention and headlines at the moment. And obviously what's happening over there is really nothing short of a tragedy. First and foremost, what's happening in the Ukraine, it's a humanitarian crisis. Our thoughts and prayers are absolutely with those who are suffering as a result of the conflict. It's a disastrous situation. I don't want to play that down in the slightest, but nevertheless, John and the team at Redwheel, indeed many of you listening in on the call as well. We have a fiduciary obligation to clients, and so alongside that, the sort of human cost of war, the economic implications are also massive, and particularly in this instance. So I think over the last few weeks, we've all learned a lot about Russia and Ukraine and their contribution to the global economy. I've certainly been a little bit shocked about the extent of the region's importance to global trade. And so, as a result, I think a significant portion of today's discussion will probably be focused on how the team at Redwheel have viewed the situation in Eastern Europe, what they've done within the portfolio to date, and their expectations moving forward. So on that somber note, I'm pleased to introduce John Malloy live from Miami. John co-heads the emerging and frontier markets team at Redwheel. He's been covering emerging markets for more than 25 years. Certainly seen a few crises in his time. Importantly, over his career, John has managed EM debt portfolios. He's managed long-short EM equity portfolios, as well as the traditional long-only strategy that everyone's familiar with. So he does bring a very unique perspective to the space. So thanks again for joining me, John. Okay, so we might kick things off, and I'll let everyone read the disclaimer there while I hand over to John. But maybe to kick things off, do you want to just step us through how your thinking regarding the Russia-Ukraine conflict has evolved from late last year up until now, and if you can explain how you've sort of adjusted portfolio positioning to reflect those views as well, that'd be helpful.
Thank you, Luke. Thanks, Channel Capital, and thanks everyone for joining this morning. We started focusing on this issue toward the around October, November of last year. As many of you might know, we have advisors, Rice, Hadley, Gates, Manuel, led by Condoleezza Rice, former Secretary of State, Steve Hadley, who worked with her as National Security Advisor, and then Dr. Robert Gates, who was the Secretary of Defense under Bush and Obama, and then Anya Manuel, who worked with Condi at the State Department. And the biggest issue that they started to see was the massive amount of troop buildup, not just in the east of bordering Ukraine, but surrounding Ukraine, and that really alarmed DC and the military complex. And so we did actually in the fourth quarter start to adjust the portfolio, obviously not in anticipation of a full crisis and invasion that we're seeing today to this extent, but we thought that the volatility would increase. There's a chance that he would go towards, Putin would try to take those eastern provinces. We thought he would likely stop there, but that's not the case. And so in thinking through that, we did reduce some of our exposure overall. We did reduce one position completely, which is a company called Yandex. It's the technology leader. Obviously, in retrospect, that was a good move, but unfortunately, we continued to have exposure to Russia, which was an overweight position of about 1% compared to the index. So we had about 4.5% going into this crisis, which The index was slightly over 3%. That position, the index position, one of the reasons why we took that down is it is traded on the NASDAQ. It's traded as a tech stock. It was, compared to other Russian stocks, it was very highly valued. Sberbank and Rosneft, which we held, were trading at single-digit PEs, very, very high dividend yields, yet Yandex was trading at a higher valuation. One of the reasons why we kept the existing exposure in Russia was because of the very, very attractive valuations. It's obviously, again, we didn't see that support coming through. So we did, as we started to see the crisis heat up and troops move forward, we sold very aggressively across the board. And we were actually in a fortunate position to completely get out of our exposure in 3 days. So we had a hit to the portfolio. It was about 130 basis points, but given the extent, of the crisis, how quickly it happened, I think we handled it really pretty well. There are, and I think it speaks to active management. If you look at passive, didn't even have a chance to move at all. Many of the larger core managers continue to hold stocks that obviously they're marked to zero, but they still hold those securities. And I think, the fact that we are nimble, we've seen it before. As Luke mentioned, I've been in emerging markets since 1993. We've seen these crises and how quickly they can unfold. But that's how we handled the situation, Luke.
Yeah, and so you touched on Rice Hadley Gates. I think you mentioned before the call that you just caught up with them in the last couple of days. Do they have a view on the situation currently and how it's sort of likely to play out from here? And what are your own expectations?
We had a call with them this morning. So unfortunately, it's not going well for Putin. I mean, and I say unfortunately because Putin, is living in his own world, and so he's looking more and more like Kim Jong-un in North Korea, who's isolated, surrounded by not many people. He's fed information that could be misinformation, and what especially Dr. Gates got into is that it looks like the military operation is failing. But as Condi said, that Russia has the brute force to continue. And so as much as there's rumors about them being close to talks or close to a negotiation or the negotiation heading in the right way, it seems like it's going to continue for a long time. And so that's unfortunate for the Ukraine people. It's also unfortunate for the Russian people because many Russian people don't support the Putin regime. It's also unfortunate for the region because the region will suffer. It's going to suffer because of the political risk around Russia, Ukraine. Just to kind of back up, I mean, Putin was isolated during COVID, and even before that, we know that he's been extremely paranoid. So he doesn't use cell phones, he doesn't use the internet. He has a very, very close circle, meaning maybe a half a dozen to a dozen people that are close to him. And even now, he doesn't trust those people. So we're dealing with a person that is completely unpredictable, is living in history. I mean, as Bob Gates said this morning, Russia just wiped basically 23 years of progress off the table. They moved backwards in a 2 or 3 week period. So it's really incredible. We can get into the sanctions, but these sanctions that they're putting on, and it's going to become tougher and tougher, as it goes forward. But these are the toughest sanctions that's been put on Russia. They would be similar to sanctions that have been put on Iran in the past. And where the sanctions really start to bite is when the U.S. starts to put pressure on China. And the Secretary of State Blinken is going to have a meeting with his Chinese counterparty coming up soon, and they're going to discuss these issues. And we got into that today that, as the U.S. puts pressure on China to distance themselves, whether it be banking, whether it be oil, gas, materials, That's going to be another issue that Putin faces. So, a reversal of the sanctions is not in the cards. I mean, not under Putin. So this is, it's not looking good. Let's put it that way. And again, I think, what our team came away with on the call is that this is going to be with us for some time. And, today oil's back down. I think oil was down 8%. Brent oil, it did close down at 107 off a peak of, 130. We're going to be in a world of high oil prices for some time. We're going to be in a world of high gas prices, high commodity prices. And, we will be in probably a world of higher equity volatility as well.
Yeah, so the sanctions is a really important point. I think not just for Russia directly, but for us and the rest of the world. Can you just talk a little bit further about how that's likely to flow through in terms of inflation and the impact on growth, given how important Russia and the Ukraine are in terms of commodities and the agricultural sector for global trade?
So we already had issues within the supply chain, prior to this Russian crisis. We already had pressure on commodity markets prior to this crisis. And I think it just really exacerbates all of that. And it's not because of what's necessarily going to be going on the ground in Ukraine. It's going to be bad. And Putin is sending in literally 17,000 mercenary Syrians, jihadists, and they're not nice people, as we discussed on the call. So that's bad. But what it's going to do is, and as you probably have read, I mean, Europe basically has changed their position on the military spending and increasing their defensive position. Germany's targeting 2% of GDP in military spending. That's 110, 120 billion dollars. You're probably all very familiar with the nuclear sub deal that the US has had with Australia. This is a global phenomenon where we're going to see defense spending increase dramatically. And so prior to this event, we had issues around commodities that were due to energy transition. Copper, nickel, cobalt, even oil and gas. We have the divestment of oil globally, many institutions are. And so that's just a starting point. The whole commodity complex is going to be tighter going forward because there's going to be more demand from defense and also from the strategic reserves. Do you really think that China is going to run down their strategic oil reserves, or the US? I mean, they're going to be they're going to be run by the military, these strategic reserves. So that's one part of it. I would say the other part of it is self-sufficiency. So more and more countries are looking to become more self-sufficient. The West is looking, they don't want to be sufficient. They don't want to rely on China. Europe doesn't want to rely on Russian oil and gas. So that just completely shifts resources as well. And so again, in a world where labor's tight, the labor market continues to be difficult, we've seen wage pressures across the board. So I think, we're in a world where inflation will be higher for longer. Does that mean we have runaway inflation like the 70s in the US? Probably not in the near term. I mean, we still have massive deflationary pressure. We still have enormous productivity gains because of that. But I think we're going to see this, and it possibly ends up being a potential stagflation for some countries that really can't generate the growth but are stuck with these higher prices.
So how have you been trying to take advantage of that thematic in the portfolio, John? Have you been sort of adding more energy and commodity exposure aggressively through other jurisdictions, or how are you trying to capture the opportunity there?
Yeah, so when Saudi's an emerging market these days, and it moved into emerging market status about 3 or 4 years ago. It's been creeping up in terms of the size in the index. Right now, it's about 4% of the emerging market index. And that might not sound large, but that was larger than, it's larger than Mexico, it's larger than South Africa, it was larger than Russia, it's on par with Brazil. But the important thing too is it's growing as the Saudis come to the market. So we increased our Saudi exposure in the fourth quarter when we were bringing down the index intentionally to keep that energy exposure. And even though we don't own Aramco at this point, we own a bank, we own a telco, we also own the largest aluminum producer, which is a low-cost producer, Martin, in the Saudi market. So we think that that continues to be interesting, and we've been adding exposure to Saudi this year throughout kind of the crisis. Just a note on Saudi, if we're overweight, we have about 5.5%, but if the market, our competitors were to go to market weight, that would be equivalent of $100 billion of buying. So there's a huge amount of money that's on the sidelines, not in the Saudi market, because of the history, because of MBS and Khashoggi. But the reality is that Saudi is opening up. Saudi's transforming the economy. They're spending trillions of dollars to shift away from hydrocarbons. They're investing in new cities. They're investing in materials. They're investing in solar, hydrogen. And so we think that Saudi is really interesting. The other area, which we could talk about in a bit, would be countries or companies that fit into our EM travel theme. And so Thailand would be a great example. That country is very, very leveraged to tourism. And fortunately, I'm going to be in Australia in a couple of months. So people are getting back on the planes. People are traveling, all the way around the world, and that's going to benefit certain themes that we have in the portfolio, in addition to those commodity energy areas.
Yeah, and so in the past, we've sort of seen when you have these sort of exogenous shocks in emerging markets, it tends to create a bit of a rush for the exits. Liquidity can dry up pretty quickly. Are you seeing that in other jurisdictions other than Russia? Obviously, those that have been able to have got their capital out of Russia, but are you seeing that the same sort of effects in other equity and currency markets in the emerging world at the moment?
Well, really, I mean, this crisis happened so fast with Russia that many people didn't have time to sell. So we were fortunate. So one of our discussions before was where did people reallocate to? In many cases, there wasn't a reallocation. It was, you had 4% and then you had 0. Where we have seen, some, opportunistic buying come in would be the countries that, Central Europe, Kazakhstan, for example, Poland, Hungary. There has been money coming into those areas. We have not put investments there because we think it's still too early, and still, the risks are really too high. So we're sitting on the sidelines there. Unfortunately, during this incredibly volatile period, we've had 5 Chinese ADRs that have been cited by the US SEC to be delisted. And so this is a process that could take as long as 5 years, but that set off basically a correction in the ADRs last week, in the Chinese ADRs. The Chinese ADR market, before this meltdown, was about $1 trillion. So you have seen extreme volatility in those names. We didn't have much exposure. We had, but after we sold today, we have about 50 basis points. We had a couple percent. We sold that down very, very aggressively, but this is a big market. It's also a complicated market because not only do you have common equity, but you have convertible bonds. So what happens to a convertible bond that now is trading below par, where you're going to be converted into equity and the equity is delisted? So this is something that I think you're going to see more and more on. Again, it speaks to active management versus passive, or having the ability to move pretty quickly. And again, we have very little exposure there, but that would be one particular area that the liquidity is hit just because risk sentiment is at very extreme levels.
Okay, and just one more question on Russia from me, and I can see there's a bunch of questions coming in from the audience, so we'll get to those as well, and please keep sending them through. But just sort of looking into the crystal ball, and it's probably a fair way into the future, but from your perspective, what would sort of need to change for Russia to become investable once again? Do you think it's likely to happen anytime in the sort of medium to long term? And in the interim, I mean, obviously Russia's been removed from the indexes, but do you sort of maintain your coverage to the extent that you can on Russian corporates? And sort of how do you sort of expect to manage that sort of?
Yeah, I mean, we view Russia as uninvestable as long as Putin's there. And, you know, as Bob Gates said this morning, I mean, the only way that Putin's leaving office is feet first. So, you know, this is a person who, as we all know, former KGB, very paranoid, probably even more paranoid. You can see by, you know, his photo ops and whatnot. So, you know, could it happen tomorrow? Could he be taken out tomorrow? Maybe. Could it be in 5 years, 10 years? Maybe. I met in the late 90s, I met President Chavez in Venezuela, and still Chavez isn't in power. He died of cancer, but his second in command is. So, you know, that's a 20-year period where they've destroyed the economy, destroyed the stock market, the currency is worthless. So, you know, Russia's off the table until, you know, there's a significant change with Putin leaving. And then I think even after that, the change in leadership, I think the world is going to be very, very suspect in terms of lifting sanctions, doing business. It's going to take an incredibly long period of time, given, you know, the credibility that's been lost, which again is extremely unfortunate.
Yeah. Okay, so maybe if we just pivot slightly here to China. Obviously, the China-Taiwan relations have been simmering for a long time in the background with what's happening in Eastern Europe. That's sort of come to the fore again. Are you seeing the potential for that to escalate into a military action as well? What's your view on the situation there? And are you sort of seeing that as being a credible risk for markets in the shorter term?
I think, I mean, when we talk about Taiwan with Rice Hadley Gates and with other specialists and doing our research, it seems like China would not be ready to take Taiwan and go and risk going against the US. It's a massive military operation. And although their military has improved tremendously, they still have a long way to go. When he speaks of common prosperity, which means, you know, employment, low inflation, economic growth. If you think that this is a disaster for Russia, what's happened, it's going to be massively worse for China, because China is an export economy. China is an economy that is open to world trade. You know, the Russian economy is basically 80+%, you know, hydrocarbons and materials. So it really had, you know, 3% value-added goods, if that. And that's probably steel. So if the world were to shut off China, it would be a collapse of the economy. It would be a complete disaster. So we don't think that that's going to happen in the near term. Could it happen at some point? Is China continuing to increase their military expenditures? Yes. Does she believe that Taiwan is part of China? Yes. So the issue with us is, you know, when does that happen? Is it this year or is it in 5-10 years? Because if it's not, there's going to be an investment opportunity as we've seen in China.
Yeah. Just on the military side as well, before maybe leave that, North Korea is also, I mean, you know, sort of started testing ballistic missiles again. You know, do you think this is just sort of posturing, or is there more to it? You know, I guess these situations have potential to flare up more broadly. Is there any other sort of concerns on your radar at the moment? Or?
No, I mean, besides North Korea, which that's incredibly unpredictable, and we saw South Korea just elected a conservative president, so it kind of makes sense for the North Koreans to flex some muscle there. But I would watch Iran very closely. The US doing a deal with Iran is not viewed positively by the Israelis. And so having Iran get more resources by selling more oil just means that their uranium program, their nuclear program is going to move faster. And so that could be something that, we wake up one day and, there's a pretty aggressive Israeli strike on Iran. And obviously that would send oil prices even higher and whatnot. So, Rice, Hadley, Gates, they don't trust the Iranians. They think it's a bad deal. So that's a tough one. Yeah. And the U.S. administration's relationship with Saudi and with the UAE is not good. So, and now they're going to them to pump more oil. So, they're looking incredibly weak. And I think that was one of the questions that came through. And it's unfortunate that the positive is we do have a midterm election coming up later this year, and we do have a presidential election coming up. And the other part is that when it comes down to it, the establishment does have a lot of power within Washington, and the military complex and the CIA and whatnot has a huge amount of pull there. So
yeah, okay. So just coming back to China, so we've seen the government there putting pressure on the local tech sector again this year. Can you sort of talk through where we are in that Chinese domestic policy cycle, and maybe what sectors, if any, are at greatest risk of further regulatory pressure?
Yeah, maybe I could share a slide with you. Is that okay, Luke?
Yeah, sure.
All right. So this chart is interesting because it shows the various periods of reform, and it also shows the market performance. And so even going back, and we probably all recall that the corruption clampdown. So when she came into power, basically purging his enemies, trying to take more and more power, that created a market environment that was very difficult. Market kind of got over it. Market did well. Then we had other periods of crackdown, whether it be restrictions on overseas lending, P2P sector came under pressure. Even years ago, we had pressure on education and tutoring regulation. So that was in the sights of the government even before the past year or so. There was pressure on Tencent and gaming and on the smaller gaming industry, basically to regulate them, and they wanted to obviously censor them, but also control them. And now we're obviously going through this period. I think we're if you look at the equity valuations, you look at the Alibabas of the world, and these larger stocks have corrected massively, some of them 70, 80, 90%. So in terms of price action, I think you've seen a lot of it. The Chinese have come out and said, towards the end of last year, that education was different from other sectors. And again, going back to common prosperity and where they want to go with technology, it wouldn't fit to basically completely annihilate the technology industry. So I think the part of the issue, though, is Xi has been pretty quiet. This is a very important political year for Xi, and until he changes directions, a lot of his minions will continue to put this regulation on, thinking that they're serving the big guy. So I think again, we're probably close to the bottom or the end of that regulation, and we're possibly even close to them putting in some monetary policy. This is just, if you look at credit impulse in China, and you can see it incredibly volatile, but we just went through a period that it declined very rapidly. Unlike developed markets, China has been very, very disciplined in terms of lowering rates. Fiscal stimulus as well has been very orthodox. So they have the ability to put in not only monetary stimulus by cutting rates, the overnight rate is still very high, but also put in fiscal stimulus. And again, I think that's just a matter of time.
Yeah, and how does that tie into the property market in China? Obviously, there was a lot of press around Evergrande and a few other developers in China late last year that seems to have fallen off the front pages at least a little bit. How is the property market in China at the moment?
Well, yeah, I mean, I think you have to differentiate. I had an update call with my China team this morning, and Chinese real estate prices over the past 3 months are slightly up. So now, if you read the papers and the research and whatnot, you wouldn't think that. So, what's happened is Evergrande being kind of the big one, but Evergrande's been a problem for a very long time. Evergrande has had, it basically, you could say it's a Ponzi scheme. It's definitely, a massively leveraged entity. And finally, they hit a liquidity wall. With that, you have other smaller companies coming under pressure as well. But we think for the overall housing market, it remains relatively intact. If you look at companies like Venke, the large, or Kohli, the large established real estate developers, they're in okay shape. That said, this can't go on. So the government has to put in, the PBOC has to put in liquidity to help the overall market. Otherwise, it's unsustainable. So that's what we're watching very closely, to see that they put in some stimulus to really support the market. But we don't see a scenario where the entire property market comes crashing down. You still have urbanization. If you look at the urbanization rate in China, it's about 65, 70%. In many developed markets, it's 85 to 90%. So there's still a story there, but they need to really put that liquidity into the market. The dollar bond market is very dangerous right now. There's massive amount of volatility, and that's not probably going to be the focus of Xi and the administration. Just like ADRs are not the focus. I mean, they'll look inward to the local markets to provide financing.
Yeah, and so I guess if we just sort of wind back to all the challenges that COVID put on the global economy, obviously supply chain disruptions were massive, and it really sort of shone the light on the need to maybe diversify supply chains, and a lot of the developed world has started to sort of pivot a little bit to bring manufacturing home. There's a lot of talk about deglobalisation. The conflict in the Ukraine and Russia now is maybe just throwing a bit of additional fuel on the fire in that respect. How are you seeing that trend in emerging markets, and is that creating some challenges for those countries that really rely on manufacturing and exporting as an engine room of their economies? Well,
I think people talk about it and companies talk about it, but it takes a very, very long time. And the cost of labor is much, much higher. And so, it's just very, very difficult. It does take a long time. We're finding opportunities. We're finding countries that benefit. So if you look at Vietnam's in our frontier bucket. We invest in up to 20% in frontier markets, and Vietnam has done a great job attracting capital from the Samsungs of the world, who are investing billions of dollars a year. Now, can it replace China overnight? Absolutely not. And that's one of the big issues that we have, is nobody can replace China overnight because they've done such a good job of it. If you've ever traveled to India, they don't have the infrastructure, the logistics to handle making tens of millions of iPhones a month. I mean, they just can't do it. And so unfortunately, we're going to be somewhat beholden to China in certain areas that we might not want to be buying products from. People will put, and consumers will put pressure on those companies, but it's going to take a long time. But the beneficiaries besides Vietnam are also Mexico. Mexico borders the US. Mexico has very strong manufacturing capabilities in the north. I think Brazil could be a country that could pick up some of that. Brazil does have a dynamic industrial sector. The currencies are very cheap. So I think you see those opportunities. Indonesia, Malaysia, Philippines, they have the ability to pick up. I mean, actually India does, but it's just taken a long time because of the bureaucracy and corruption in that market.
Yeah. Again, I wanted to touch on monetary policy in the US in particular. I mean, we're obviously almost certainly about to embark on a pretty aggressive rate hiking cycle, QE rolling off, etc. How do you sort of expect that's going to play into EM equity and currency markets? I mean, obviously the US dollar's appreciated very strongly recently as well. Is this going to create a headwind for emerging markets, or what's your expectation of how that plays out?
Well, I think there's a few things going on in terms of we're coming out of COVID. The job market actually is recovering in the US, so you're starting to see that kind of come back. Consumer confidence is very, very low in the US, and so I think there are a couple drivers there. One, the administration's doing a pretty poor job. Two, everybody's concerned about inflation. Everybody thinks that they see it everywhere they go, especially at the pump filling up their car, and so that just feeds into the consumer sentiment. And then finally, rates have been going higher. So if you look at mortgage rates in the US, they're up probably 100 to 200 basis points, depending. The bond market's been pretty volatile, but they're definitely moving up. And also the housing market's been very strong through COVID. So, people want to buy a house, but the house price is up 50%, 100%, and the mortgage rates are up. So it's despite, the fact that headline economic growth is okay and the stock market's doing well, consumer doesn't feel that great. So I think it's going to be interesting. I mean, at one point, the market was probably pricing in, and I think Merrill or Goldman still pricing in 7 hikes for this year. We think it's probably likely to be 3. We think that they're probably going to end up seeing data coming through in the next few months that end up in terms of inflation, seeing inflation roll over, just because of the year-over-year numbers coming through. And so we see a environment where, yes, rates are going up, but probably more at a slower pace. I mentioned earlier the technology, deflationary world that we were in before COVID. We're still in that world. I mean, productivity is still gaining. So, we think that towards the end of the year, we'll probably settle at an inflation number of 2.4 or so in the US, but that will be coming down. We still have yet to see long-term inflation expectations increase in the US. So I think, we probably have a little bit more to go on the 10-year. We'll obviously see what they do this week and see how they talk about this week. But they will look through these commodity shocks. They will look through, $130 on Brent, thinking that it is just, a short-term effect. So I think they're going to be probably more focused on the downside and some of that weaker data that we're seeing come through.
Okay. And I guess on the back of that, one of the interesting dynamics we've seen in developed markets, well publicized, there's been quite an aggressive rotation from growth stocks towards value names as those inflation expectations have been rising and interest rates have been moving up. Have you been seeing the same sort of dynamic in emerging markets? And are you sort of positioning the portfolio more towards those sort of cyclical names to take advantage of that, or is it less pronounced in EM?
Yeah, I mean, we try to think of it in different terms as opposed to growth versus value. I mean, we've had material exposure, commodity exposure for a long time because we think it's a growth opportunity because of climate change first, and now because of the new environment that we're in, which is basically the new Cold War. So, copper could be a growth opportunity. I mean, today we saw Rio Tinto take out Turquoise Hill, a Mongolian copper mining company. So clearly they're not worried about China. They're spending almost $3 billion to buy a copper mine that basically has one client, which is China. And they paid from, the premium from yesterday was like 34 or 35%. But if you look at the stock, I mean, the stock is up dramatically. And so here's one of the largest, miners in the world telling you what they think about copper and what they think about China. But back to your question, I mean, when you think about growth versus value, I mean, Russia for many investors was probably in the value camp. Well, that's the risk of value. I mean, things are priced for the risk. And, So, we try to think again more holistically about it. Some of the miners that we own trade at, First Quantum, our largest position, trades at 6 times EV/EBITDA or 5.5 times EV/EBITDA. That seems really cheap to me in a material that's scarce and going up, and they have growth production. So, our starting point is growth. We don't want to buy growth at any price, which was a market that we were in a year ago. And look at any of those. Look at C. Look at look at any of the internet companies. They're down 50, 60, 80%. They were trading at literally 20 times revenues or 30 times revenues. And so we didn't have that exposure. We avoided that risk. But are we starting to buy some of those stocks in Latin America, like Mercado Libre? Mercado Libre is corrected about 50%, is trading at a reasonable valuation. They have a clear market position in that entire continent, not only in e-commerce, but digital payments. In terms of, a multiple of GMV or a multiple of sales, it's at like 5.5, 6 times, which that's very, very reasonable. It's not the 30 or 20 that we were seeing before. So again, we like to think that we're buying the company. What are we going to pay for the company? What are the growth rates, and what do they look like? I should mention, we, as you know, Luke, we have a stock price for every stock in the portfolio, and we aggregate that. The upside price target right now that we have for the entire portfolio is over 60%. This is the type of return that we saw in the COVID crisis. We saw at the end of 2018 after the US-China trade war. So we don't know when this is going to end, and there's a lot of negative news, but the risk reward, is looking pretty favorable. But so, that's kind of how we look at, the opportunity set.
Great. Okay. So one final question from me before we get to some from the audience. So if you can just touch on which macro indicators you're watching most closely at the moment, and then any sort of final comments that you have on recent performance, what's worked well for the portfolio, what's been less successful, and your sort of key positions and themes for 2022.
I mean, I think the key I mentioned earlier would be China monetary policy and China policy overall. I think that's key, and it's been moving in the right direction, but slowly. And I think that's really a concern for us. We also, continue to monitor, obviously, inflation in the supply chain. I mean, the supply chain has been easing up. If you look at the port congestion and some of those indicators that track, although BDY, the bulk dry index has increased recently. So we have kind of bounced in some of those areas, but those would be a couple of indicators that we're looking at. In terms of areas that have done well, the commodity complex has helped quite a bit. And so our copper themes, we have exposure to gold through gold fields in South Africa. Our Brazilian exposure, because of Brazil being tied to commodities and being potentially at the end of the rate cycle, that exposure has done well. Besides Russia, in addition to the losses that we've had in Russia, China has weighed on the portfolio. At this point, we have a pretty large underweight in the technology, but China volatility has resulted in losses to the portfolio. As of now, we're down a couple hundred basis points against the index year to date. That would be kind of well within our historical tracking error, which historical tracking error is as much as 7 or 8%, and our vault tends to be higher than the index. The characteristics of our strategy is we do well on the upside. We have very strong upside capture, and on the downside, we try to be in line with the overall index. So that's how we've done.
Great. Okay. Well, so there's a bunch of questions here. So we'll try and get through as many as we can. The first question here is around sort of back on the geopolitical front. Do you think that the US admin is far too weak to put any sort of pressure on China at this point?
I mean, it's a great question. I think people are, and even Rice, Hadley, Gates, Manuel, who come from Republican administrations, early on they were pretty surprised at how aggressive they were on the sanctions. So I think they're doing a good job there. They would have probably rated them, a B plus, A minus. So that's good to see. I think it's going to be, the next step's going to be pretty telling because, how we provide and supply arms to Ukraine. I think the no-fly zone, from what I'm hearing, is off the table, even from Republicans, just because it pulls us into a war that we probably don't want to be in. And I think if you ask the average person on the street in the US, they don't want to be there. I mean, we just pulled out of Afghanistan after 20 years. So I think that's going to be pretty complicated. I think it's going to be pretty difficult. Will they be able to handle it and push that way? I mean, the military does have a lot of control, and the Democrats and the Biden is very, very weak in the polls. So, he might be forced to do something that is unexpected, and he might push away the progressives of his party who have been, kind of pulling the other way. So, these are times when, politicians do become unpredictable. One thing's for sure, I mean, prior to this, DC was 100% bipartisan against China. Obviously now, the US is 100% against China. Russia, the world's 100% against Russia. And so, we'll see how far it goes. But again, I would not underestimate the fact that he's low in the polls to do something. And so, that could be, the catalyst.
Okay, we've got another related question here, which is, doesn't China have to continue supporting Russia, as if they let Putin fail, then they risk a change in Russia's leadership, which risks seeing a Western-influenced government in Russia? Interesting question. What's your take, John?
No, that's a great question, and clearly, that would make sense, and I would say that they would probably try to, keep a balance, knowing that yes, they have to continue to buy gas as they do from Russia, possibly buy oil. The gas, one of the main gas lines that they have was a tens of billions of dollars. I think it was a $50 billion deal that was negotiated after the annexation of Crimea. So the Chinese have been opportunistic to try to do deals. The US is in a tough position if the Chinese were to continue. I mean, we already have sanctions on 250 billion of Chinese goods. So, I think that's probably the logical position, that they're not very vocal about it, but they continue to support Russia by buying resources, taking advantage of deals that they can strike. I think that's probably likely. And obviously that's not going to play well in DC.
Yeah. Still on the regulator sort of side, but there's a question here around the SEC and the sort of these ongoing sort of threats to delist a number of the large Chinese tech companies. What's your take on that, and what's your sort of view more generally on the VIE space?
I mean, that's something that's irreversible, really. I mean, unless the Chinese are going to allow the US to fully audit companies, which they're not, then that's going to continue. And, as I mentioned earlier, there were 5 companies that were put on the list. That's just the start of it. If you look at the supply demand, it's going to be very hard for those companies to be absorbed into the Hong Kong market. There's going to be liquidations. We're seeing liquidations now. They're going to be margin calls. The brokers are already getting margin calls. And then you also have market issues around things like convertible bonds. So you might even have defaults as a result. So that's an incredibly difficult situation. I think as an investor, I would stay extremely far away from that. As I mentioned, we have, one very small position there that has dual listing that we are actively getting out of, and we'll probably be out of that position in one day. So I think possibly could the Chinese change their view on that? It's a hard thing to see happen. And there might be positive rhetoric that comes out from China saying, oh, we'll work for some solution, but the U.S. Congress is not going to stop on this, and Biden beating up the Chinese just resonates with U.S. voters.
There's a question here on President Xi in China. There's some sort of headlines circulating suggesting that he may not be re-elected later this year. Is that just hyperbole? Do you think there's any chance that happens? And if he didn't, then who would be the successor? And what sort of ramifications do you see there?
I mean, I think maybe Xi isn't exactly like Putin, but he's pretty close. I mean, I think if you looked at how he consolidated power, how he changed the government structure so that the military reports to him, he's basically controlling all arms of it. If you look at how he's purged, literally purged, his adversaries. So it's possible. I mean, it's possible too that he's taken out. I mean, there is definitely, disagreements within. We're hearing that. I mean, this goes back to many, many years to a number of families that really have a lot of power within China. And that is a scenario. But again, it's you can't predict it. I mean, Castro was in, Cuba for many years while the CIA tried to take him out. So I think, what we're going with what we think was the most likely that he does remain in power through these meetings and through the end of the year.
There's a question here on ESG and sort of asking about how you sort of view things like human rights violations, unfair work practices, discrimination, etc., and then sort of how that pertains to your previous positions in Russia and current holdings in China and other parts of Asia.
Yeah, I mean, we've been focused on ESG, as I mentioned, since we started the strategy for a decade. So well before, the market as it is now, it's focused on it. We have a head of ESG and we have an ESG team. We fully engage with our management. We use Sustainalytics and ISS as third-party checks, checking the supply chain. We meet with our companies. We engage with our managements. I think we start with again, the due diligence, meeting with the company, understanding the companies. Obviously, there are some companies, because we've been in the markets for so long, that we view as uninvestable. And many of those companies, even in China, like a company like Hikvision, which we avoided for years, ended up being sanctioned. So we try to take a pragmatic approach to it. We also, though, try to find opportunities. I mean, within even China, which China is an incredibly deep market with thousands of companies listed, great businesses that are family-run businesses, that are consumer-run businesses that have best standard practices in terms of ESG, in terms of how they disseminate information. So we have very little. Actually, at this point, we have zero SOE exposure in China. So if you own a Chinese bank, I mean, is that Chinese bank working for you as a shareholder or working for the the Communist Party? And we think it's working for the Communist Party. So it might be cheap, but it's clearly not working to give you returns. So again, we try to be pragmatic. We also invest in, as I mentioned before, commodity producers, and that's an area that's often shunned by ESG-focused investors. But the reality is if we want to transition away from hydrocarbons, we need more copper, aluminum, nickel, cobalt, lithium, whatever. We need that, and we need to continue to use oil. We need to transition, not stop oil overnight, because otherwise, it's ironic. You have these institutions like Harvard University that sits there with a $40 billion pension saying they're not going to invest in hydrocarbons. And what is happening is basically North American oil market is incredibly tight. So gas prices here at incredibly high levels, and that's just a regressive tax on very, very poor people. It's a regressive tax globally. And so the world has to wake up to how they deal with climate change, which is obviously the E in the ESG.
Right. Okay. And there's a question here on just on frontier markets. Someone asking about liquidity in frontier markets at the moment, whether that's dried up a lot, and how you're kind of managing your exposures to frontier at the moment in this environment.
So frontier markets are even much more leveraged than emerging markets. If you look at in terms of the commodities. So if we look at the commodity cycle, soft, wheat commodities, soy, all these, many of these smaller markets, or in the case of oil, Nigeria. So as we have commodity markets doing well, these economies are getting more liquidity. They have current account surpluses, money's coming in. If you look at frontier markets, they did extremely well last year, despite emerging markets being flat. So we're starting to see actually money come back into frontier markets. It's not crossover investors. It's some very, very sophisticated institutional investors, but it's locals. They're locals who know the businesses, who see the valuations. It's also private equity and industry, who again, they know the businesses, they see the companies, they see that they're trading at 2 to 4 times EV/EBITDA, and they're taking them out at premium. So we are seeing liquidity come back slowly to frontier, but I think that's just the beginning. I mean, I think frontier is super interesting. As I mentioned, we have around 11%. We've been increasing our frontier. We've been increasing our indirect frontier as well. So buying a company like MTS in South Africa that has a huge business throughout Africa, including Nigeria. So half of that business really is catering to frontier consumers.
Great. Okay. I just want to squeeze in one final question. There's a follow-up here from your previous answer to the question on the SEC. Just asking, does this basically make Hong Kong listed Chinese stocks a no-go zone for you?
It doesn't. I mean, I think if we look at those businesses and look through those businesses, we continue to invest there. Obviously, if they're tied to the government, if they're tied to the military complex in any way, we avoid those and we screen for those. But we still have some exposure in that market as well as the Asia market.
Right. All right. I know it's getting pretty late in the evening over there now, John. So I'll let you go now. But thanks again for your time. It's always great chatting to you, and really looking forward to having you down in Melbourne and Sydney in a month or two. So yeah, it'd be great to see you, and good to catch up.
Great. Thanks, Luke. Thanks, channel.